Risk off continues in today's Asia session as the US-Iran standoff/war continues to intensify. Gold and oil continues to extend their rally from yesterday's session. West Texas crude oil is up by around 1.7%, trading above the $71 US dollar per barrel as we're speaking right now. Gold XAU/USD is up by around 0.7%, holding firmly above the 5,200 US dollar per ounce. And as well as we continue to see weakness in key benchmark Asia stock indices with the Nikkei 225 as well as the Hang Seng indexes down by around more than 1% as we are speaking right now, together with around 0.5% to 0.6% losses seen on the S&P 500 and the Nasdaq 100 E-mini futures. The US dollar was mixed yesterday, so overall the US dollar index rose by 0.9%, its best single day rally in the past 3 months due to fear of the Swiss central bank intervening to put a cap on Swiss franc strengthening, where the dollar Swiss strengthened by close to 1.3%. But however, commodities currency, continues to trade firmly against the US dollar. The Aussie is only down marginally yesterday by 0.3% as it continues to held firmly and stage a rebound after retesting its 20-day moving average. Very good morning to all and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be the Tuesday, the 3rd of March 2026. So as usual, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Right, so here we go. So we know that this ongoing US-Iran conflict/war has extended to the 4th day as of now. Today's Asia session, as we are speaking, 11:05 a.m. Singapore time. So these are some of the couple of headlines that are still fresh in the global market space over here, which I'm going to share with you guys. All right, so over here, today's Asia session, we see the conflict extending into the Middle East region, especially on key stakeholder like Saudi Arabia. So right now, there's actually a drone attack by Iran, a target that has already been targeted on US embassy. Right, so that created a ongoing negative feedback loop on the global benchmark stock indices as we are speaking right now. And due to the fact that yesterday Trump also insists there is no fixed timeline that potentially could end this ongoing US-Iran conflict. So it seems to us that whatever initial thoughts of symbolic attacks by both sides akin to last summer is getting lesser and lesser in possibility, and this potential ongoing conflict may persist. And some market watchers are looking for a scenario like a Iraq War 2.0, we call it a comparison. So there could be a chance that US may send ground forces to Iran if Iran continues to retaliate attacks across the Middle Eastern key stakeholders countries. And with this reiteration attack, Iran chose to target various energy choke points. Number one, yesterday we saw drone attacks that causes the one of Saudi Arabia's biggest oil refinery to shut down. So that could potentially restrict global oil supply, putting a firmer footing on oil prices. And in terms of other energy products like liquid LNG, I would say in short. So LNG, yesterday, Qatar also got hit as well. So Qatar shut down its LNG production, and this LNG production is the world's largest, all right, the world's largest LNG export plant. And we know that European economies are pretty much primarily dependent on LNG supply, and that actually sent European gas prices to 54% yesterday. creating inflationary pressure to Eurozone economies, and which also saw a negative feedback loop on the European benchmark stock indices, like the German DAX, which traded down negative 2% yesterday. And in this ongoing, we call it Iran threat to actually create a squeeze up in energy prices, potentially hitting back the Middle Eastern countries that is supporting US/Israel attacks on Iran. Iran also chose to actually inflict much more, I would say that much more negative follow through in terms of global energy prices. So we know that the Strait of Hormuz is a key oil supply flow globally. So any shutdown or any restriction of this Strait of Hormuz will potentially see oil bunker reducing, and also we potentially starts to see countries that reliant on this oil supply coming from Saudi Arabia that are unable to actually fulfill their orders as soon as possible. So that actually explain why oil dependent countries like Japan, China, in some form, South Korea, and even Singapore, in a way or another, potentially could create a negative feedback loop. That means our energy needs, we need to actually source out for higher prices, and that could potentially see a negative knock-on impact on these oil-dependent respective economies. So Iran continues to actually put, we call it a pressure on threatening to actually restrict global oil/energy flows, and it actually promised or vows to attack any ship trying to pass through the Strait of Hormuz over here. So net overall, what we could see is that we could potentially see some kind of stagflationary pressure coming back into the global economy, something very similar during the start of the Russia-Ukraine invasion or conflict arising from between 2021 and 2022. So if this scenario were to happen, that could actually see a reduction or a chance that the US Federal Reserve may not be so aggressive in cutting rates this year, and that has already been priced in by the CME Fed Watch 2. So if you look at the CME Fed Watch 2 over here, very high chance that the March meeting, which is on next week, 2 weeks from now, 18th of March, almost 100% the market participants in the Fed Funds futures market, as compiled by the CME Fed Watch 2, is expecting the Fed to stamp at, holding the Fed funds rate at 3.5% to 3.75%, and 83% chance to stamp at again on the 29th of April meeting. Then I'll to share with you on the June meeting, which is the first summer months. Initially, prior to the last weekend US-Iran, we call it conflict that took hold, there was a chance about 70% that market participants are expecting a 25 basis point cut on the 17th of June 2026 meeting, and now it becomes like a coin flip, only 53% chance and 47% chance expecting no change. So the expectation of this, we call it the fourth interest rate cut so far in this ongoing interest rate cut cycle by the Fed that took hold late last year, is being pushed down the calendar much further down the road. So market participants now expecting the fourth cut in this interest rate cut cycle, or the first cut of 2026, to come in only on the 29th of July, which is a high chance of 87%, to bring it down to 3.25% to 3.5%. And looking at either in the month of the October or December month, which is the 28th of October 2026 FOMC meeting, or on the 9th of December 2026 FOMC meeting, which is the last meeting for 2026, to ignite another cut for this year, which is at a 61% chance and 8% chance to bring the Fed funds rate down to 3% to 3.25%. So as we start to see oil prices continue to inch higher, so there's much fearful by some market watchers that if this US-Iran conflict continues, and if there could be more threat or attacks on other Middle Eastern oil supply refinery by Iran drones or Iran missiles, that could actually see a significant reduction in supply of oil prices, and that could significant supply of oil. All right, so that could potentially be what US wants instead, because if the Saudis are unable to produce oil for the rest of the world, the rest of the world will rely on US oil supply, or we call it from the frankers themselves. So that could actually benefit US frankers company, which is the US energy stocks as per se. So net overall, if we start to see 100 US dollar per barrel for oil, that could potentially increase inflationary expectation, which in turn reduce Fed rate cutbacks for this year, and that could be negative for the US stock market as well. So before we jump into the individual technical analysis, let me share with you guys on this intermarket analysis, which I spoke about yesterday, which is very important right now, is the ongoing US inflationary expectation as being expressed or implied by tradable instrument, which is the US Treasury protection securities. So from there, we are able to deduce or derive the US 10-year break-even inflation rate and the US 5-year break-even inflation rate. So these two rates are tradable, are based on tradable instrument, means based on what market participants are expecting in the global markets. So take it as what is potentially the US inflation rate will be 5 years from today for the 5-year break even, and for the 10-year break even is what will be the US inflation rate 10-year from today. All right, so in the light blue line. So we know that if you look at the light blue line and the dark blue line has starts to inch upwards yesterday, in line with the steep rise in oil prices. So we know that if you look at in the past over here, this is the big rise since 2021, previously from 2021 to May 2022, where both the 5-year and the 10-year US break inflation rate rose in significant direct tandem with the significant rise in oil price due to the headache, due to that previous, we call it 2021-2022 stagflation risk inherent from that US-Russia conflict or slash war. So if oil prices continues to raise, let's say $100 per barrel, very significantly, the 5-year and the 10-year US break-even rate should continue to go up as well in tandem. So when that's happened, that could actually see a rise in that US 10-year Treasury yield as well, lagging behind, and that could potentially see a liquidity squeeze in the US financial system, which is potentially negative for US stock market in general. But except the fact that certain segment of the US stock market, like the material stocks and energy stocks, may outperform positively against the rest of the market, which has been taking hold since the start of this year. All right, so that sum up the first segment of the daily dose. So let me now move on to the second segment, which is the intraday technical outlook segment. So before I jump on the intraday technical outlook segment, let's have a quick glance at the state of the FX market. All right, over here. So this is the state of the FX market. Okay, so what we could see over here is this the 5-day rolling performance of the US dollar against the major currency. So what we could see is that we start to see a spike up in the US dollar. As we are speaking right now, the dollar seems to be inching downwards on the intraday basis. So if you look at the 1-day rolling performance of the US dollar against the other major currency, the commodities currency continues to remain in a firm a bit over here, where the dollar Aussie is down by negative 0.25%, followed by the dollar against the Chinese offshore currency, the CNH, down by negative 0.22%, and also the dollar Kiwi is down by negative 0.09%, and our dollar Sing is down by negative 0.10%. So there is some form of dollar weakness, particularly in several currency, especially against the commodities currency, where the Aussie dollar tends to benefit in terms of rising commodities prices as well. All right, over here. Okay, so now let us now take you through the intraday technical outlook segment. All right, so with that, let me expand my screen. Okay, so let's start with the euro dollar first. All right, so let me go to the euro dollar. Okay, so the euro dollar, okay, let me expand the screen. So the euro dollar broke below our pivotal support at 117.40, drifted downwards towards the second support at 116.73, which is right exactly at the 200-day moving average over here. So since that it managed to held above the key 200-day moving average, I will have a neutrality stance for today. So neutral between 116.73 and 117.40 on the euro dollar. Only a clearance above 117.40 on the euro dollar will see a mild recovery to retest 117.90 in first step, which was yesterday's Asia session high. Above it, potentially seek out 118.33, 118.60 next, which is the minor swing high of 23rd of February and 26th of February. So that's for the euro dollar. Next will be the sterling pound. So the sterling pound yesterday, we have a neutrality zone between the 200-day moving average and at the 50-day moving average at 135.23. It broke down below the lower neutrality limit at 134.50 and decline, hitting our two support level at 133.48, almost hitting 133 figure level, where it printed an intraday low of 133.14 during yesterday's European session. And what's interesting over here is that the hourly RSI has managed to shape a similar low. So this is considered as a bullish divergence as well. And what we could see in today's Asia session, it managed to stage a kind of a bullish breakout above this descending trend line resistance, indicating that the downside momentum has started to ease as we are speaking right now, 11:19 a.m. Singapore time. So with that, I'll be using 133 figure level as my short-term pivotal support. Flip to a bullish bias for today for a potential minor counter trend rally in the first step. Two key resistance to look out for will be 134.50, which is the 200-day moving average. I think as a similar resistance level as well. A squeeze up above 134.50, potentially seek out the next intermediate resistance level at 135.23, which is pretty much close to the 50-day moving average, and as well as this key medium-term descending channel resistance that has been in play since its 52-week high, since its year-to-date high, which is printed on 28th of January 2026. However, price action continues to plunge downwards and breaking below 133 figure level. The minor mean reversion counter trend rally scenario will be invalidated to see the continuation of the bearish momentum taking hold, exposing the next support level at 132.65, followed by 132.20, which is the 1.382 Fibo extension in this ongoing decline since the high of 28th of January, and 132.20 also confluence with the minor congestion area of 2nd of December last year. All right, so that's for the Aussie dollar. Next will be the commodities currency, which is one of the commodities currency, which is the Aussie dollar. So the Aussie dollar continues to trade pretty firmly above this 20-day moving average, testing it for the third time yesterday. So no change as it still can't break above a 0.7140 key resistance level. I will still maintain a mild bullish bias using 75.35, 70.20 as my short-term pivotal support level. Clearance above 71.40 will potentially see the bulls gaining more traction to expose the next intermediate resistance level at 0.7175, followed by 72.10, which is a 0.764 Fibo extension from the low of 0.6 of February, and the 0.68 Fibo extension taken from this low of 18th of December last year. However, a bearish breakdown below 70.20 will invalidate this mild bullish bias scenario on the Aussie dollar to kickstart another round of minor corrective decline sequence, exposing the next near-term support level at 69.80. Breaking below it will seek out the 6th of February minor swing low area and the minor congestion area of 26 and 27 of January at 69.05, 68.90. Next, we also confluence with the rising 50-day moving average. Next up will be the dollar yen over here. So the dollar yen squeeze up towards our medium-term pivotal resistance level, which is the swing high of 9th of February, before it induced a multi-day sell-off previously over here. And what we could see is that the hourly RSI has started to stage a bearish breakdown from a parallel ascending trend line support level. So with that, I will have a mild bearish bias on the dollar yen using the medium-term pivotal resistance area at 15750/75, which is yesterday's swing high. First support level to watch will be 156.83. A breakdown below 156.83, potentially seek out the key near-term support level at 156.17, which confluence with this minor ascending trend line that has been in place since 17th of February low and very close to the 50-day moving average as well. Only a breakdown below 156.17 will potentially allow the bears to gain more traction in the first step, testing out the 155.42 support level next, which confluence with the 20-day moving average. A squeeze up above 157.75 invalidates this bearish scenario to see the further extension of the rally towards 158.30, followed by 158.90/159.23, which is the swing high area of 22nd of January and 23rd of January this year. So that's for the dollar yen. Okay, next up will be the intraday outlook on the major global stock indices, starting with the Hong Kong 33. So the Hong Kong 33 continues to remain capped below yesterday's Asia session high, which is at 26,285. So with that, I will have an adjusted downward short-term pivotal resistance on the Hong Kong 33 that's representing the Hang Seng Index using 26,285 adjusted short-term pivotal resistance level, maintain a bearish bias for today. First support level to watch 25,970/25,820. A breakdown below 25,820 sees further weakness towards the key 200-day moving average, which is confluencing with the graphical support level at 25,530, which is the minor swing low of 30th of December and 31st of December, and also the one-time Fibo extension of this ongoing minor corrective decline sequence that has been taking shape since the high of 29th of January this year. Only a bullish breakout above 26,285 will negate today's bearish bias to see a squeeze up towards the next intermediate resistance level at 26,500, which is the 50-day moving average, and the 26,728 next, which confluence very closely to the 20-day moving average. All right. Next will be the Japan 225 representing the Nikkei 225. So like I mentioned, the Japan 225 yesterday, we do have a bearish bias indicating that the 20-day moving average may not hold, which indeed it actually broke down in today's Asia session, given the fact that the Japan economy is also pretty much dependent on oil imports over here. So with higher oil prices, that could potentially put a drag on Japanese economic prospects. So that actually explains the reason why the Nikkei 225 is facing this negative feedback loop, at least in the near term. So with that, I will continue to maintain a bearish bias on the Japan 225 that is representing the Nikkei 225 with a slightly downward adjusted pivotal resistance for today, 58,147. So using 58,147, maintain a bearish bias on the Japan 225. Next support level to watch will be 56,096, followed by 54,818 next over here. Only a bullish breakout above 58,147 that would invalidate today's bearish bias view to see a squeeze up towards 58,008. Breaking above 58,808 will potentially see a retest at the current all-time high area at 59,884/60,075. Next will be the Germany 30 representing the German DAX. So the Germany 30 broke down below our lower neutrality range at 24,610. So for today, we will flip to a bearish bias from a neutrality stance using yesterday's US session high as my short-term pivotal resistance level, 24,740. Two key support level to watch in today's bearish bias will be 24,413, followed by 24,250, which confluence pretty much closely with the 200-day moving average. Only a bullish breakout above 24,740 will invalidate today's bearish bias to see a squeeze up towards 24,847. Breaking above 24,847 will see a higher drift upwards towards yesterday's Asia session high over here, which is Asia session swing high. Okay. at 24,990. All right, which also let me put it in writing. Okay, oops. Okay, 24,990, that confluence with the 20-day moving average. Okay, next will be the US stock indices, starting with the US Wall Street 30, that's representing the Dow Jones Industrial Average. So yesterday we have a neutral day stance. So the price action did a bearish reaction right exactly at the upper neutrality range. We saw confluence with the 50-day moving average. So with that, potentially we may start to see another form of intraday bearish leg developing on the US Wall Street 30 after its bearish reaction right off exactly below the 50-day moving average and right exactly below our lower upper neutrality range that we highlighted yesterday at 49,079. So with that, we will flip to a bearish bias for today using 49,079 as my short-term pivotal resistance for the US Wall Street 30 that is representing the Dow Jones Industrial Average. First support level to watch will be yesterday's swing low area at 48,345/48,198. A break below it will expose the key medium-term pivotal support at 47,860, which is the lower limit of this ongoing medium-term ascending channel drawn from the low of 23rd of May last year. However, if price action reverse upwards and have a bullish breakout and an hourly close above 49,079, that would invalidate today's bearish bias to see a rebound back up towards 49,360, followed by the key range resistance of 49,707, 49,940. Next, the S&P 500. So the S&P 500 also staged that bearish reaction of the upper limit of that neutrality range that we highlighted yesterday, also the 20-day and the 50-day moving average. So that being said, or that being observed, we will flip to a bearish bias stance from today as well for the SPX 500, 6,907, 6,919 will be my short-term pivotal resistance zone. Two key near-term support level to watch on an intraday basis, 6,809, followed by yesterday's swing low area at 6,785, 6,769. Breaking down below it, we'll see a test on the key medium-term pivotal zone at 67.33, 67.33, 67.20. However, a bullish breakout above 69.19 that would invalidate today's bearish bias view to see a squeeze up and retest the key range resistance level at 69.72, which is the minor swing high of 26th of February, and as well as this ongoing descending trend line resistance that has been in place since the current all-time high of 28th of January this year. Lastly will be the Nasdaq 100. So the Nasdaq 100 also reacted exactly at our upper limit of the neutrality range that we highlighted at 25,078 and also reintegrate back below the 20-day moving average, indicating further short-term weakness ahead. So with that, we'll flip to a bearish bias for today, 25,078 short-term pivotal resistance. Two key support level to watch for today, 24,670, followed by yesterday's swing low area at 24,495. Breaking below it will expose 24,333 and potentially also 24,140, which is the medium-term pivotal support, and also confluencing very closely with the 400-day moving average. Only a squeeze up and a break above 25,078 will invalidate today's bearish bias view to see a squeeze up again to retest the key range resistance level that has been in play since 4th of February, got rejected by the bulls on 11th of February and 26th of February. That will be 25,377, 25,430. All right, so that sum up all the intraday technical outlook on the broad-based stock indices. So let us now go to the commodities market, starting with gold XAU/USD. So gold managed to shape that minor bullish reversal right above our Titan short-term pivotal support that we highlighted, printed an intraday low during the US session at 5,260. 5,238 remains our short-term pivotal support as it still can't break above the first resistance level at 5,448. Above 5,448 will see a retest at the current all-time high that was printed on 29th of January this year at 5,602 in the first step. However, a bearish breakdown below 5,238 that would invalidate today's direct bullish bias view to kickstart another minor corrective decline sequence to revisit the rising 20-day moving average and the lower limit of this ongoing minor ascending channel drawn from the low of 6th of February, confluencing with a next intermediate support zone at 5,111, 5,046. Right, so that's for gold XAU/USD. Lastly will be the all-important West Texas crude oil over here. So the West Texas crude oil continues to rebound and is now looking to retest yesterday's Asia session high, which is 73.35. Now it's trading at 72.58 as of we are speaking right now, 11:33 a.m. Singapore time. So using yesterday's Asia session low at 69.26, pardon me. So adjusted upwards slightly, 69.26 as my short-term pivotal support level, maintain a ongoing bullish bias for West Texas oil. The next resistance level to watch will be at 74.70, 75.55, which is the 19th of June 2025 swing high, and also confluence with the 2 times Fibonacci extension in this ongoing bullish impulsive upmove sequence from the low of 17th of February. Clearance above 75.55 potentially seek out the next resistance level at 78.10, which is also the 2.618 Fibonacci extension. Only a bearish breakdown below 69.26 will see a retest of the former 1st/4th of August 2000 minor congestion now turns into a key pullback support level, and also the gap up support that is being formed in yesterday's Asia session yesterday at 67.8. Only a bearish breakdown below 67.8 will trigger another round of minor corrective decline sequence to retest the rising 20-day moving average, confluencing at the next graphical intermediate support level at 64.80. All right, so that's for West Texas oil, maintaining a bullish bias with a slightly upward adjusted pivotal support at 69.26 for today. All right, so before we go, let's have a quick look at the economic calendar. What are the key data to look out for? So bear in mind that the key primary news flow will still be anything that is coming out from this ongoing US/Iran conflict. But nevertheless, there are various other events that could actually influence the market as well. So at 12 p.m. Singapore time today, on the 3rd of March, Tuesday, we have Bank of Japan Governor Uda's speech. So it's pretty much important to hear his view on the potential negative impact of persistent higher oil prices on the Japanese economy and how that would impact the current we call it gradual tightening monetary policy stance that is being adopted by the Bank of Japan. So that will be at 12 p.m. Singapore time, and that could influence the dollar yen and the yen crosses. And at 6 p.m. Singapore time, we have the aggregate Eurozone core inflation preliminary data for the month of February. Market participants expecting no change at 2.2%. Right, so that could influence the euro dollar and the euro crosses. And at 10:55 p.m., very important to hear what is the opinion on Federal Reserve official Fed Williams. So Fed Williams will be speaking at 10:55 p.m. Singapore time to hear his view on this ongoing US-Iran conflict and how does it impact the inflationary trend in the US. So that could also shape the major US dollar pair and in some form the major US stock indices. So that will be at 10:55 p.m. Singapore time, and followed by 12:55 a.m. Wednesday, early Singapore time, 4th of March, another Federal Reserve official speaking, Fed Cascagri, all right, over here. So before we start our daily dose tomorrow at 11 a.m. Singapore time, at 8:30 a.m. Singapore time on Tuesday, 3rd of March, we have Australia data, which is the Q4 GDP growth rate over here. So that could potentially also influence the movement of the Aussie dollar. And also at 9:30 a.m. we have Tier 1 China economic data, which is the state compound MBS manufacturing PMI and non-manufacturing PMI for February. And also 15 minutes later at 9:45 a.m. we have the private compound rating dock manufacturing PMI and rating dock services PMI for February that consists of the Chinese SME. And bear in mind that over here is that on the 4th of March, we also will start to see the start of the Chinese 2 session, which kickstarting the Chinese People Political Consultative Conference. So this session is rather important at the start of it because the top leadership will reveal its growth GDP target for 2026. So market participants expecting a slight decrease to about 4% to 5% from the last 5 years target of around 5%. But most importantly, the readout is a kind of a closed door policy meeting. But however, by the end of the conference on the first day, usually the local press will report certain key readouts from the meeting itself. So the readout, one of the readouts will be, would there be a mention about jumpstarting consumer spending in the Chinese economy, which has been lagging in the past 5 years. So that could potentially influence in some form the Aussie dollar, given that the Chinese is considered as a main importer of Australia raw minerals resources, and also in some form the Hong Kong Hang Seng indices, and as well as the China A shares benchmark indices over here. So that will be tomorrow. All right. So with that, that sum up today's Daily Dose of Market Insights. I'm Kelvin here, signing off. Wish you guys a great day ahead, and we shall speak again tomorrow. Thank you.